Greetings. Keith Prather here again with NCM Economic Update for June. So I'm going to jump in and get right to the presentation. Here we go. So just have a couple highlights for you this month. The Automotive Demand Index that we watch, which this works a lot like a leading economic index, so it kind of gives us an idea of what to expect over the next 6 months. Right now, it's actually still performing pretty well. So we see that it's kind of in line with what we had prior to the pandemic, a little bit above the long-term average. But we did slip a little bit month over month. It came in May, which is the latest set of data that we have available, at 60 points. That's down a little bit from 60.9 points, about 1.5% lower month over month, but it was still 9.1% higher year over year. So we're still in a fairly good demand environment looking forward. And that's not to say that there aren't some headwinds, and I want to talk about just some of the things that we're watching. One of the first things we're watching, and I talk about this a lot when we're in the 20 group meetings, is just the impact of real disposable income on auto sales. And real disposable income is pretty simple. It's just inflation adjusted income for families when we strip out taxes and we strip out some of the basic mandatory types of spending households have every month. So it's the money that's left over that they had to go out and make big ticket purchases. And of course, the higher their inflation adjusted disposable income, the more confident they are and the better they feel about making longer term big ticket purchases. So what we have for disposable income and is a trend that we don't like to see. It is a negative trend. It's decelerating. We got just a slight improvement in the latest data that we got out of June. It was up 1.1% year over year, but that's still lower than the pace that we had in 2023 when we were running at about a 4.2% clip. Now that 4.2% was against a pretty sizable drop in 2022, but this is still weaker than what we would like to see on a long-term basis. I went back and did the math, and you can see that during the decades in the 1960s, we averaged about 4.6% real disposable income. In the 70s, it was 3.5. So it's decelerating as we go over time. But even in the 2020s, we should expect it to be a little more around 2% or a little bit higher. So for the rest of 24, we're expecting it to be around 1.4%, in 2025, around 1.4%. And I made this comment last month, and I think it still holds that as we go into the election, I think one of the things that we're going to want to listen to is how congressional members and how whoever's running for president at the time, it talks about tax cuts and what happens with the Trump era tax cuts that were taken by Congress and whether they get extended at the end of 2025. Because if they don't, that becomes a direct hit on disposable income. That pushes it down. And then we see again, as it dives, you see that corresponding dive in auto sales. So those are the two connections that we want to watch very, very closely. And right now, I think we can predict that we have a fairly stable environment, but there's more to the story. So household spending expectations, even though this disposable income looks like it's under a little bit of pressure, if we look at expectations that households have over the next 6 months and how they plan to spend money, you can see that generally we're still more optimistic and still planning to spend more over the next 6 months. So if you look on a historical basis, it's stronger than we had prior to the pandemic, even though the trend line has been, kind of coming off of its peak, but it's flattening out of late. So still, again, pretty decent overall, not recessionary, doesn't feel like a major slowdown. But the real story is back to this. And I know I've talked to you about this before. I just wanted to reiterate it one more time. It seems like when I'm in the 20 group meetings and I'm speaking and I put this K up, suddenly a lot of light bulbs go off. I think for a lot of automotive dealers, they're kind of scratching their heads a little bit because some of the upper end brands still can't keep models on the showroom floors, right? They're selling as fast as they can get them in. And upper end SUVs, hybrids, some of the luxury models still doing very, very well. And it has to do with this economic recovery. And economic recovery that we've been going through is very rare. It's a K-shaped recovery, which means that some segments of households are actually doing phenomenally well, maybe record levels of income, even when you adjust them for inflation. So those households making $75,000 a year and more have a ton of disposable income. I mean, the stock market has been performing well, their wages have been increasing, inflation has been less of a factor on them, and so they do have just a ton of disposable income, and so they're out spending. There's also some other things that we're picking up. The great wealth transfer is underway right now, where baby boomers and those in the silent generation that developed a lot of wealth and stock market and mutual funds over the last several decades are now at that age where they're passing that on to those who inherit from them. And so we see this great wealth transfer. We expect that to be almost $90 trillion over the next 20 years. So as that accelerates, you have a lot of households that are kind of down in this middle income segment, even maybe some in the lower income segment, that are suddenly going to get this tremendous influxes of wealth, and that shoots them into the upper end of the K, but then they have a lot of wherewithal then to go out and purchase and to buy their dream cars and to make a lot of big moves. So a lot of different things going on in the economy, but that's why we're hearing these real differences between dealerships and what their experiences are. What types of models are moving, what types of models aren't. It's a little surprising to us. It doesn't seem to fit with a lot of historical norms, and it's because this is, again, a very rare recovery coming out of the pandemic. So last two slides I had for you, just wanted to show you our forecast again for at least what the models are showing as forecasts for automotive. And again, the big story here is we just don't see a lot of deceleration. You don't have anything that feels recessionary. In fact, it looks like production overall is going to continue to trend upwards. And again, I think a lot of that has to do with that K I just showed you, and the upper end of the K really driving a lot of those sales. This particular model still performing really well, 6 months out, running about 98% accuracy. So again, we do see a nice little uptick between now and the end of the year, and then it continues to kind of move up at a fairly manageable growth and fairly manageable pace moving forward. Now, we do update these every single month, and so as I get new updates, I'll pass those on to you. And the last thing is just the outlook for the general economy. And the general economy is still doing pretty well. Q2 looks like it probably is going to come in stronger than this expectation of about 0.7%. Right now, it's running at about a 2% clip. Should be somewhere around 1.5% and 2%, which is fairly average for Q2. And then for Q3, we're still expecting somewhere between 1% and 2% growth, and in Q4, 1.3%. I mean, the bottom line is for the full year, we're still expecting about 2% growth, which is what we would normally expect. In the decade prior to the pandemic, that was our average annual growth rate. And so it's still going to continue to hum along at those good averages. So in all, it's almost like steady as she goes. If we were a ship, we'd say that at least the demand environment, despite some fits and spurts in the marketplace, is still generally doing pretty well. And we think that that will kind of continue, despite some of the headwinds that we get. And next month, I'll talk more about the Federal Reserve, but we still think the Federal Reserve is looking at least one cut this year. We may get up to two cuts this year. And that would also help spur some additional sales. Some customers that are sitting on the sidelines looking for overall prices to come down a little bit and maybe a little bit of help on the interest rates suddenly decide maybe now is the time to buy. So anyway, that's what we have for June. Reach out to me if you have any questions about this or anything else in the presentation. Please take a look at the briefings, and everybody stay safe and healthy. All right, take care. Bye-bye.